Hey, Cynthia here, your blessed broker or your mortgage sidekick. I wanted to share with you all just a couple of little things about the mortgage process. A lot of people go into wanting to purchase a home and they be stressed out and they be overwhelmed, but technically you shouldn't be. It should be one of the most exciting times of your life. Like you get married, exciting, have a baby, exciting, purchase your home, exciting, but a lot of people have like really bad experiences and I really just hate that. So I'm just gonna give you a couple of little tips, not really tips, but things that happen in your journey along the way and a lot of things that people should receive that they are not receiving. I wrote this book in 2007 or 2008 when the housing market crashed because I learned by attending a meeting that a lot of people did not understand their mortgage. Their mortgage wasn't explained to them properly by the mortgage loan officer, the realtor, nor the title company, and that just really broke my heart. So I wrote the book to help people. And the thing of it is, I'm going to redo some things in it because we know from 2007 until now, a lot of things have changed in the industry. But always remember this, the basics will always remain the basics, like 2 years of work history, 30 days of bank return, no open judgments, bankruptcies, or whatever. If you do have an open 13, you need the courts, the judge, permission to purchase a home or something like that. As you see, I have this book up that I wrote that I was talking about. Here's the actual book. Like people don't deal with books anymore. Um, so I'm just going to talk from experience to you as if you are my client or my customer. So when I was a mortgage processor, I've been a mortgage processor. I started out in 1993 with All America Mortgage as a mortgage loan officer. Back then, you had to do all the work yourself. You had to call people from the white pages, or you had to pay for a list through AT&T. Your conditions was called STIPs back then, and we went and had to fax them over to the underwriter and things like that. We had to know how to calculate, and we had that big old Texas Instrument calculator, which a lot of people still have. So I started out in sales, then I end up processing, becoming a processor because I knew how to get conditions, to do income and things like that. I became a traveling contractor throughout the US, which was absolutely amazing. And I also did some underwriting level one because when as a traveling contractor, they usually tend to not let the outsiders underwrite like at the level of two or higher unless you had like your charms or something like that. But once in a while they may. But normally they hire underwriters that have a certain, like not not back then they didn't have to have like a master's or a bachelor's degree. They just knew how to underwrite and have their charms. So the charms means that they was licensed and approved by FHA. And that's all that means. So the process goes like this. You're looking to buy a home. For nowadays, you should be looking to buy a home a year ahead of time, and you should work with a mortgage loan officer, whether it's in retail or wholesale. So I'm in wholesale, and we know wholesale is wholesale, it's cheaper. And retail is usually the bank institutions, the big banks, the institutions like PNC, Wells Fargo, Chase, things like that. that is what we would consider retail. And so a mortgage broker like me who owns their own mortgage company, you come to my company to get your mortgage loan, and we have loan officers that help you. But the difference between the retail and the wholesale, we have multiple lenders that we are approved with, that we can see which scenario or which pricing product they have best to fit your needs. And so we could use that person versus with retail, they only have that one particular products and one particular thing that they can do. So when you go to apply for a loan, again, you should do it a year in advance, but if not, that's cool too. You should have a loan officer that sit down and explain everything to you, including your rate, the pricing of your rate. If you don't close on time, how much would it cost you more for your rate? It's not the product itself, it's the rate product. How much more would you have to pay if you behind in your closing, or who has to pay? Does the company pay, or does the borrower pay? You should know all of that. What type of product that they are putting you in. They should explain the mortgage payments, your interest, your property taxes, your homeowner's insurance. They should explain, like, if you need PMI, that's mortgage insurance, or they should explain with FHA MI. MI is for the life of the loan unless you refinance and come out of FHA. But FHA charge mortgage insurance for the life of the loan, usually because of the simple fact of you being over 80% loan to value, LTV, loan to value. Um, Once you get your credit pulled, you are ran through an automated um, desktop underwriting system. And that's what the mortgage loan officer will run through at first, unless he's one of those type that has his mortgage processor to do all of those things. Then she would take the application information that he provided, or she, and run it through a desktop underwriting system. Once you come back approved, they have either a lot of stuff, a little stuff, or just some basic things. And usually with the basic things, the processor, if she's good at her job, she would ask you for those things up front. So then when she submits your loan to underwriting, the things that was listed on a desktop underwriting summary is provided, and she could submit your loan and have a clear to close. But anyway, your loan is then submitted to the underwriter come back with the contingencies of what is needed for the approval, and that's what the contingencies mean. It means that you have items that need to be addressed, but you are approved upon those contingencies being met. You should get a welcome call from your mortgage processor or your loan officer if he doesn't have a processor. With the welcome call, they should go over everything with you. You should receive, whether it's retail, wholesale, you have to receive a loan estimate. Back in the day, it used to be called good faith estimate, but now, unless it's a reverse loan, they have it as a loan estimate, and it's just an estimate, but it still should list the in betweens, like it should cost this, it may cost this. Another thing too to remember, that with all of the changes because of the market crash, they have a tolerance now. You can't go over 10% tolerance. You should know that. That's important for you to know, because if a loan officer quotes you a certain price for the title company and this and that, they are only allowed a certain percent to be incorrect. Other than that, they have to eat the cost. And so that is listed on your loan estimates that you should legally receive within 3 business days. Once your loan documents is received, please go over each one. Your mortgage processor or loan officer should be going over those things with you. And a lot of times they don't, but they should. It's their job. And as a good mortgage loan officer or good processor, they will sit down with you and go over your loan documents that you receive in the mail. So the next thing happens is once you go over the list with your processor or loan officer, you then send in the documentations. Once you send in the documentations, if you slow with it, then your loan closing is going to be slow. If you are quick to send in those documentations and you have a great communication with your mortgage processor or your loan officer, baby, you can get that loan closed quick. And yes, you can. And some companies, I'm just going to speak in wholesale, can get your loan closed less than 30 days. Another thing to know that's extremely important when you're doing a purchase, we have to make sure everything is closed and done by that closing date that you have on your contract. So if your purchase contract have 11/11/11, hypothetically, then we have to make sure that it's closed by that date. Another thing too that's extremely important, that your interest rate. Your interest rate should never expire. We shall always have the closing done prior to your interest rate expiring because it costs either you, the borrower, or the lender. So it's always important that the mortgage loan officer or your processor make sure that you close before your interest rate expire, unless there are some unforeseen things that happen that's out of your control or out of their control, the lender, and no one can help it. But still, they're going to find someone to eat that cost, trust me. And even if the sky come down, they're going to find it. So that is that right there. So your contingency documents are now sent back to the underwriter for them to review. Always remember, you have to have a 2-year work history. In your 2-year work history, you must have the same job or be in that same industry. It looks, if you are always over the place, they will consider that like she does or he doesn't have reliable income. So that's why they look for a 2-year history in the same industry. However, there are some exceptions to the rules. And so make sure you go over that with your loan officer so they could be aware of that. Your bank statements always have to be 30 days in advance, and you cannot, whatever you do, have money being moved in and out all around your bank statement, because then when we send it in to the underwriter, she's gonna look at it to say, what is this money? Where is it coming from? I want a letter. And then the customer, you get frustrated, you get mad, and you're like, I sent in my bank statement. So why is the underwriter adding something else additional? Why I don't get that? And you become frustrated. So to stop and to avoid the frustration when you're getting ready to purchase a home, make sure that it's clean. It's clean meaning only your income coming in. You're not transferring, moving money all over the place. And if you are transferring money from one account to the next, be ready, be prepared to provide the bank statement for that additional account as well. So they are really, especially since the mortgage crash, they are really, really looking on it. And a lot of times they will request a what is called a bank verification of the amount of money that's in your account or your account. They will sometimes request that in the for the processor to get. So not always, but a lot of times they do. They do a verification of mortgage or verification of rent. That's why I was telling you guys you don't have to worry about adding rent on your mortgage on your credit report and paying people, because that's usually requested verification of rent or mortgage, verification of income, and they have a system that they use. People cannot lie like they used to about having a certain amount of income. So don't dock you up your check stubs or anything like that, because of the simple fact is that they pull directly from the IRS. They pull your transcripts. So your transcripts get pulled directly from the IRS. A lot of people don't know that, and they get caught sending in false bank statements and false check stubs. When a lot of times we request that information anyway, but not all the time, but a lot. So, but one thing is always requested is your transcripts from the IRS to make sure that you make the amount of money that you say you make. Because when the market crashed, a lot of people was falsifying check stubs and bank statements saying that they made this money and they had this money and they was getting approved for homes and they didn't really have it. I know everybody want to put the blame on the people that works for the mortgage companies or the banks, but a lot of that was both on both sides. They knew what they were doing, and when it came down to it, they couldn't afford the homes that they was purchasing, wanting to live above, their means or in that dream home. When I say always start with a starter home and don't get house poor by sitting up there purchasing your dream home. And so another thing too, after all of the documents have been sent back to the underwriter, she would then give us a clear to close. When she gives the clear to close, the loan officer or the processor will have your um, homeowners insurance requested with the mortgage e-clause and on the homeowners insurance. Now, the reason why the mortgage e-clause is on there is because the bank, the lender, whomever want to make sure that they get paid. And even though you're going to get paid too, but the banks want to make sure that they get paid for whatever damages that happens in your home. Another thing too, sometimes if you don't have mortgage insurance, the banks, the lender, whomever, would do what they call a force insurance. So they will place insurance on your property by force, and they would be the only people collecting money if something happened. With the condo is different. The condo has insurance for the inside walls, and that's where you have insurance for the inside walls. And the condo association, they have insurance for the outside walls, unless you are in one of those just 3 stories and it's not owned by a corporation or anything like that, and it's just you guys. So you all will have to work that out with the maintenance and stuff like that. Again, your credit needs to be with no open collections, no bankruptcies or liens or anything like that. And if you do the year prior to, try to get those things off. If you can't afford to pay for a credit repair company, DIY, do it yourself, baby, because what you're gonna do, they gonna do the same thing, just send in dispute letters. So don't worry about that. Um, the purchase terms. When you get ready to purchase your home that you found that you love or that you want to work with or you can see yourself living there, make sure to get a home inspection. A home inspection is not the same as an appraisal. When you first purchase your home, you get a home inspection to make sure you don't have no cracked foundation, you don't have no plumbing issues, no roof issues, things like that. If someone tell you that you do not need a home inspection, they a lie. They a bald-faced lie. And that money is going to cost you up front. So make sure you have your home inspection, your appraisal money, your credit report. Some lenders give free credit reports to get you to come in and things like that. Some companies, if your credit score is good enough, they could waive the appraisal fee. But either way it go, you have to pay for the home inspection like nobody else is going to pay for that. And then, like I said, the closing, the appraisal is paid for out of pocket. And the appraisal is done for the value and for certain things. See, the home inspection, they look for like the deep things that make you say, oh, I'm not buying this. Like if you have a certain type of mold and issue that the because you know how sometimes people plaster up and make stuff look good, and the appraisal he may not catch that, but the home inspector will. So it's a difference between a home inspection when you purchase a home and the appraisal. And your title information will be recorded on once you go to closing. When everything is clear, they give you now what they call a clear to close, a closing disclosure. We didn't have that back in the day. We had the HUD settlement, but now they no longer use the HUD settlement. They use, unless you're doing a reverse mortgage, they use the closing disclosure, and the closing disclosure looks exactly like the loan estimate, whereas you are going to get a breakdown of everything that's being charged to you, your title, the title company name, your loan officer, your lender, everything, the fees that we charge, things like that is going to be listed. Your processor or your mortgage loan officer shall always call you when you get your CD emailed to you or mailed to you or however you receive it. If you go into the lender's office, should go over it with you step by step so that you are comfortable, so that you understand what you are reading, looking at, so you can see all of the fees. And then it should give you it should give you what you would need to bring to closing, the amount of money that you would need to bring to closing, so that you can make sure that you have a cashier's check ready. Only time they take a personal check if you are under, I think it's $1,000, then they'll take a personal check. But other than that, no, you have to have a cashier's check. I'm texting my little baby because I could hear her and she don't have her phone on mute. So that should be only the only thing. So you have everything listed, who's charging what, the title company, the how much your rate costs, everything is gonna be listed on there. Your homeowner's insurance, even if you pay for it out of pocket, you got to pay for your homeowner insurance out of pocket. If you escrow, you don't escrow. No matter what, you still got to pay for your homeowner's insurance. And a lot of time the underwriter will take the homeowner's insurance and give you like a certain amount that needs to have saved in your bank account what they would call reserves. And that's just to make sure especially if you're really close to your debt to ratio. That's just really to make sure that you have enough money to pay your homeowner's insurance and property taxes. So they will call that your escrows. Another thing too is that sometimes when you're really close to your debt to ratio, the underwriter will request to make sure you have 6 months of reserves of your property taxes and insurance and stuff like that in your bank account to make sure that you are able to pay your monthly mortgage payment if something happened or go wrong for 6 months. So a lot of times they don't request that, and a lot of times they do. So then that's why I say it's really important to go over everything with your um, mortgage loan officer or your processor. And so once you get your closing disclosure, you have to sign it within a couple of days and send it back. And then they schedule your closing. Then once they schedule your closing, um, it, doing a purchase, the seller always have the right to choose the title company versus the borrower. They do not have that privilege over the seller. And so once you all schedule a closing, you go to the title company or you could go to the lender's conference room if they know what they're doing. Like me, I took the test for loan signing and no, and I have my notary um, commissions number and stuff like that. So I am able to help my clients to close wherever they may be because you can have a closing um, basically anywhere because now we could do remote closing. So these are just some simple steps that I wanted to go over to make things a little bit better. I don't want people to be stressing out. I think it's really, really exciting to purchase your first home, your second home. Is always a different experience and it should be a good experience. So I hope this helped. I will be bringing you more things with regards to your mortgage. Stay blessed.